Good afternoon, ladies and gentlemen. Welcome to today's Stock Market Brief Show. We're going to talk about preparing for the face ripper, the melter of a rally that can come at any given moment. We're going to talk about some of the sentiment charts that are kind of lighting up the scene out there on the Twitter sphere or X sphere. We're going to go into following up on the follow-through day that occurred in some of the index products, follow up on seasonality, which is going to be an important one too. We're going to talk about, obviously, the market conditions and some expected moves there too as well. This episode is brought to you by my partners and my patrons. So if you want to take a look at this stuff, the pinned comment there has the links to all this good stuff. If you haven't done so already, make sure to subscribe, turn on notifications, and of course, it's greatly appreciated. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. I wanted to talk about some of these sentiment surveys because I find it to be interesting, and I'm going to give more context around these, right? There's few surveys that come out weekly. The ones that I'm pointing out on the screen here have been rather depressed readings for 4 weeks now straight, getting into and around that minus, or sorry, 60% level for the bears. This is investor sentiment. And what I wanted to do here was kind of flip this on its head and just look at the bears section for these last 4 weeks. And if you do so, take a look here at this, the rolling 4 weeks of this specific investor sentiment survey. And you look back to the left, the other times that we've seen these type of bearish readings, we're at pretty much significant bottoms. I found this chart out here by Subu Trade on X, and he pointed out the same situation, but what he added here underneath was actually that the S&P 500, the 4-week average exceeds 57% of the time. But what he added was what happens 1 week later, 2 weeks later, 1 month, and so forth. And as you can see, when we get these type of readings from this high, which we haven't had since dating back to the 90s, only 4 times, just take a look at 1 week later, 2 week, 1 month, and so forth. Now, these statistics, right, things can always be different, but I think it's still kind of important to note and show this off. Another interesting look is looking at the bull surveys, and the bull surveys are rather depressed levels here too as well. But you can see that it doesn't really mark bottoms by any means perfectly, but it is still a rather depressed reading. Now, that is investor sentiment, and there's other surveys that we can look at, right? So people kind of get these confused because they have 2 A's in them, but you have AAII, which is investor sentiment, but who knows about the NAAIM exposure index, and that is the average exposure of U.S. equity markets reported, let me get this off my screen, reported by their members. So it's asset managers that are kind of giving you these readings, and it tells a completely different story. So first and foremost, how does this chart, how do they do the readings? Well, you get a range of responses from 200, right, to minus 200, 0%, right, which is the zero line right here, which we're really never at, very rarely. It means that we're 100% cash or hedged to market neutral. When you're up towards 100 level, it's just saying that you're 100% invested. And if you're anything above it, you're leveraged long. If you're below 0, you're looking at leveraged short positions, which is, I just haven't seen it. I've seen below 0 a couple of times on these surveys, but it's far and few between, which you could kind of see if we draw the line through 0 here, you can kind of see the times that it happened. We're at what? Lows in the market. I think this was actually coming into where the Fed did Operation Twist, and this was basically at the bottom-ish of the great financial crisis and so forth. Okay, so looking at these range of responses, this tells a lot different of a story. Why? Because we're not even below 50%. So we're still getting a reading of 64.64, which means that the majority here are still long the market. It's rather bullish. Is it fully bullish by like fully invested? No, but it's not like a depressed reading whatsoever. So the difference here between really investor sentiment, right? Investor sentiment right here, super bearish, but asset managers, I mean, they're not really feeling any sort of pain, right? Now, these are just surveys, right? So take it with a grain of salt, whatever you want. But this is where it also, but they have access to real money, right? But here's where it gets a little interesting too. You can look at the Rydex asset ratio. Now, in short, this is a sentiment calculation, but it's based upon what investors are actually doing with real money. Okay, so if you look at this, they have the Rydex has bull funds, they have sector funds, bear funds, and they got money market stuff. And basically, what they're doing, which by the way, it started with a lot less funds, now it's grown to multiple funds, so that it makes it a little bit more accurate for a sentiment reading. But the formula here is basically taking the bear fund assets plus your money market, right, and dividing it into the bull fund and the sector assets. And in short, what does it tell us? Well, when you get massive spikes in this, it's just saying that things are really typically more bearish or more toward the short aspect of money markets, or sorry, of these funds. So you can see over here in like 2003 at the dot-com bubble, you got big spikes, right? Bam. So this was basically saying, hey, this is a low, a high that we haven't seen for quite some time, could mark some bottoms, right? Same over here in 2008, 2009 great financial crisis. You saw a pretty large spike, and I have this on a log chart just so you can see this a little bit better. You can take it off log, whatever. But then you could see over here, right, the pandemic, right? We shot up to about 0.4. So maybe we can look at these levels as more of an indication of what things might look like if we get some big sell-off. But over here, right, that marked the low of, what was this called? Christmas Eve Massacre. 2020, this was the low of the pandemic. We spiked right back up to it. Right over here, we spiked up to 0.4 as well. And where was that? That was kind of the bottom of 2022. Well, I mean, we fell 10%, and where are we? I mean, we're not even really, there's nothing. It's 0.11 right here. So what's real money telling you right now? What is asset managers telling you, and what's real money telling you? That's something to be aware of versus just seeing that investor sentiment. Now, it can still play out to a face rip and rally, but now it kind of comes to the conclusion that, hey, we might need to be looking at a couple of more things here. Okay, let's go into more sentiment stuff. This is the CNN Fear and Greed Index, right? A lot of people quote this, see this, look at this, hate on this, like this, whatever. It don't matter. But what matters here is what happens typically at these extreme levels, because when you get to extremes, right? And this, I mean, it's actually tracking 7 or 8 different things, which is, it's actually pretty useful when you get to very far extremes. And you can see that here, right? So this is charting it out back to 2021. The red line is the S&P 500, and then the Fear and Greed Index is in blue, right? And when you're down here underneath this green line, that is, you're in extreme, quote unquote, fear. And when you're up here in red, you're at extreme greed. And what do you notice? From what I notice is when you get into extreme greed, you can stay in extreme greed for actually a long time. So that's one important to know. But however, once you look at this chart, what you'll notice here is kind of when we come out of extreme greed, you can see actually kind of pops through to the market and little pops more back up. So it's kind of like this area that things are getting extreme from various sentiment aspects. And what can happen, simply put, is you can see a face ripper in the near future when we start coming out of this extreme greed. And you can see that multiple times, right? You can see the quick pop over here. Then when we got out, that actually marked a bottom. We came back low, got extreme greed, boom, turned out of it, boom, we started rallying higher. Over here, what? We got into extreme greed right around here. The market went down still, kind of chopped around, then we went down again, and then once we crossed back above, it started moving. Okay, so it doesn't mean that the market's going to find a bottom using any of this, but it can be a good indication saying that, hey, if we're thinking of this in terms of a boat, right? If you're thinking of a scale or whatever, what I usually do is I use the analogy saying that, hey, if we're all on one side of the boat, we're going to start to slowly feel it tipping or going to capsize. And then all of a sudden, what happens is people run back to the other side very quickly. And then all of a sudden, you get this big rock of the boat, and people then try to start to balance out. So my opinion is you got to be in the center of the boat and kind of watch what everyone else is doing. And that's what I'm trying to kind of reiterate here and talk to you about what this face ripper rally, if it comes, when it comes, I believe it will come, but I don't think it's going to be easy. So that's what we're going to kind of more still dive into. Now, what can really drive market momentum? CTAs, right? So if we look at commodity trading advisors, which is short for just basically algorithms, right? Momentum, they'll just, when things are going up, they're going to start to turn around and buy into it. This is a massive short position over here. This it's not going to last like this for much longer. They're going to come a time where they become buyers again. So if S&P 500 kind of holds where it's at, and then all of a sudden these guys start to turn into buyers, and then all of a sudden we get some sort of convexity or whatever the word is to really move that push, they can become a real big source of that face ripper, which it's not here yet, clearly, right? Because it's basically straight down to a level that we haven't seen for quite some time. If we look at seasonality, right? Seasonality is another aspect of this, so that it drives some awareness. this. I don't know if it's going to play out the same as seasonality. Nobody does, right? But you can see here, this is S&P 500 seasonality. We just had another day, kind of went flat to sideways. And over here, right, a few more trading days left, maybe into Monday, Tuesday, this next week. Actually, the S&P 500 technically makes another low. Now, this is only based off of the last 5 years, right? So the white line is where we're at. The blue line here, it's kind of hard to see, is the last 5 years of seasonality. But the reason why I'm showing is because it is tracking rather well. Now, I can't say the same for the NDX, right? The NASDAQ 100, big tech, those sold off pretty hard. But guess what? We marked a low basically at the same exact time as it stands right now. Will it change? Possibly. But right now, what are we doing? Well, we're kind of just following seasonality still, saying that, hey, maybe into the end of March, maybe we get some good reprieve, and then we find out what happens April 2nd with more tariff news, we get more shakeup, whatever the case is. If we want to look a step further, we can look at Almanac Trader, which is like the holy grail guy of looking at seasonality, basically, okay, from Stock Trader's Almanac. He posted this out on the X, and this is the March performance in recent 21 years, and it's giving us the S&P 500, the Russell, right, Dow Jones, NASDAQ, and so forth, 1,000, 2,000. That's the solid lines, and then you can see that the dashed lines are kind of where we are right now as far as trading days go. And you can see on the right axis over here, this says 0% because that's where we started at 0%. And for the start of the month. And you can see we've actually followed pretty closely. And if we're going to continue to track this path, it does suggest that towards the end of the March, we can see some more upside. So, hey, are we going to continue this seasonality? Hey, it's a possibility, right? It's a possibility. We got seasonality on our side. Sentiment's pretty extreme so far. CTAs might want to turn the corner maybe eventually. But then let's take a look at some more stuff, right? We talked about looking for a follow-through day in the S&P 500. Now, what's a follow-through day? Follow-through day is based off of the research of William O'Neill from How to Make Money in Stocks. Great stuff. If you haven't seen that book, read it, look into it. And basically, in short, a follow-through day, the hit rate on these are like 50%, right? So it's not going to catch a bottom 100% of the time. However, 100% of the time, what it does tell you is that this follow-through day happens 100% of the times coming out of every correction in every bear market. So you can go to any correction in the whole history of the S&P 500 and basically any asset to most extent that changes a little bit. But what you'll notice is you do get a follow-through day, and that is the signal to start to add exposure. Not full throttle, full pedal to the metal, just add some exposure in case that this is something bigger, and you can always continue to add if it gets better. Because it's not about calling the bottom. It's about if this was the bottom, right? The idea is to get exposure and still, because we're on the brink of potentially breaking down further, but to get some exposure and then add more and then add more and then catch it if that actually is the bottom to all new highs, right? That's the idea. So what are these numbers? Well, you get the low, right? This closed down on the day. This was the low. And then we all of a sudden had this kicker candle, right? We gapped up, went higher. That was day one of the attempted rally. Now through day 4 through 7, you start to look for follow-through days, right? So day 1 came, boom, day 2 came, day 3 came, and then boom, we start to look for follow-through days right in here. What is a follow-through day? A follow-through day is when we get more volume than the day prior. Ding, 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 we did. But you need to be up 1.25% or higher. Now, there are some stipulations here if you don't want to do it the orthodox way. Technically, in the S&P 500, when there is lower volatility, which I wouldn't suggest this is really lower volatility as of recent, but you can have a day that's up 1%, right, in the S&P 500 with higher volume between days 4 and 7, and that can count as your follow-through day. So still, I guess, if you want to be a wiggle room, you can count this as your follow-through day, whatever. But I'd still prefer to see that 1.25% day. But I'll tell you why I'm okay with calling this one a follow-through day here in a moment. So as it stands right now, when I'm looking at the SPX chart, I'll talk about the anchor VWAPs here momentarily. But what I do want to call out is now that we had this big update, higher volume than the prior day, today was an inside trading day as we're heading into option expiration, which will give us obviously more insight. So there's the SPX, right? So technically we're on day 5 of the attempted rally, right? If you want to call it that we got one follow-through day, go ahead and say it. Qs, however, did get a follow-through day. This day was up, I think, 1.68%, and it had more volume than the prior trading session. So this was the low. We had 1, 2, 3, boom, there's your follow-through day, and then today's the 5th day, but we do technically have a follow-through day in the Qs, and then today was that inside trading day, all getting hung up at that month-to-date VWAP. Now, IWM, did have a follow through day for sure as well. So you have your low, you have day 1, 2, 3, boom. Day 4 is right over here. That's a horrible 4. Day 4 is right over here. Big update, and it actually broke the month to date VWAP. So small caps are actually showing some signs of strength, getting back above that average volume weighted average price month to date, which the other indexes have yet to do. So that was technically a follow through day for IWM. Today we had an inside trading day. We're still holding month to date VWAP. So anything below that, I'm not too happy about, but if we can hold above it, that's positive. So we do got some good stuff going on. Let's talk about market conditions and where we stand. So first and foremost, tomorrow, right, we have triple witching. A lot of people call it quad witching. It is triple witching now, but that is a big option expiration. All right. As far as macro data that comes out, nothing really on the board, really all too much. So what can move markets? Well, we have OPEX. We can look at market net flow. And then obviously we have just uncertainty around anything that Trump tweets out and or geopolitical risks, right? So we keep on hearing news bombs that kind of hit the tape. So that's obviously some unknowns as to what we can expect. As far as volatility futures, we are in the contango. So this is what you want to see. I will say that it looks nice here, but it's kind of flat in a way, right? We're at 19.4 on the April contract, and then we're looking at 19.5 on the May contract. So if we get volatility, this could really flatten out or go back into backwardation, at least in these months. But it is positives to see us start to kind of move out of that and start to look a little bit more healthy. This is what's been helping with volatility kind of coming back into the markets. If we take a look at where we stand as far as gamma levels go, the reason why I'm not going to dive too much into this is because we're going to have a lot of gamma that's expiring, and it's going to open the door to really how the market is shifting going into the next week. So I think it's going to be very important to tune in to see how this all looks coming into next week. Now, this level has been very stubborn, this 5,700. Okay, so my thought is, hey, if we get some of this roll off, maybe that at least opens the door to break through 5,700, which is actually in line with the month to date VWAP over here. And if that's the case, the next one we're going to look for is one, the gamma flip line, wherever that may be, and then the all-time high anchored volume weighted average price. I do find it interesting that the all-time high, we started bouncing into it right into the month, and then the month to date handed off right into this area. And now we're kind of pinched, right? Brian Shannon terminology, a VWAP pinch. My terminology is expansion, contraction. You can see that we're actually pinning between the VWAP lows. So in short, what does this look like? Well, I'd be more cautious under this level, let alone I'd be more cautious under 5,700 at this current moment. And then I'd be bullish above it, right? So right now we're contracting. People can look at this and say it's a bear flag. They might be right. It might break down. Okay, cool. Okay, but at least we have some idea of some levels to be aware of. Another thing that's kind of shaping up is that direction of the 5-day moving average. We got some more green on our screen here. So you have the 5-day moving average start to calculate up, but it's not easy by any means. Today we started down on the day on SPY, then we rallied all the way back up, and then we kind of just bled out for the remainder of the trading session to end up rather flat, okay? If you like these gamma levels and you want some of this data, you can check out Gamma Labs. I pinned it in the comments, the link, and then they gave my subscribers, I'm the only one with it, the MSD 50, which is the code. You can get 50% off of your first month. I think that the site actually is down for some maintenance right now, but if you want to check that out, make sure to check it out. All right, let's look at expected moves. The S&P 500 has pretty decent size expected move right now, $5.30. It's kind of been around there for the last couple of days or so, but a little bit less than some of those bigger vol days that we've seen. So that puts us up here at about, I'm just going to talk about the higher one, 572.63, which is a different calculation, and 558.35 down beneath us. If you want these exact levels, just mark them out, screenshot it, put them on your chart, okay? I send these out also, the daily EMs or these levels for various products in the Discord if you want that. You can see we've been coming up into this month-to-date VWAP, and we've just been rejecting from it. Boom, we rejected from it. Today, we try to get back above it and rejected. It is starting to flatten out, so the most bullish thing to happen here is for us to actually break it and hold that breakout. And if we can do that, maybe that gives us the juice we need to go test our upper weekly expected move going into tomorrow's trading session. The daily is not guessing for that to happen, but hey, just watch how market net flow pays out, because towards the end of these days, sometimes on like OPEX days, you can see market net flow, which I don't have a chart with me right now, but sometimes that gives insight to some squeezes towards the end of the day. So I think we might be able to just be aware of that, but just also note on these contract rolls, on these OPEX days, you get a lot of chop, a lot of back and forth volatility. So for the most part, if you're not really used to that or don't have a really really strong sense of risk management, you typically, if it is a chop day where we go back and forth, not a trend day, it's sometimes best to just kind of step aside and wait for things to settle to feel a little bit more confident. The last thing you want to do is start to like buy in and then it starts to sell off, so you get out and then it starts to bounce up and then you try to get in and then you get chopped up, right? Let's look at the Qs. The Qs about up here to 486 and some change, 472 to the downside and some change. You can see that we gapped down, we've rallied up. Look at what we're holding. It's clear as day that it's the month-to-date VWAP. That's kind of also in confluence with that whole gap down that prior Monday over here. We haven't filled that gap yet. So if we start breaking down, obviously we got to just be more cautious because that's always a possibility. But if we start breaking back up to the upside, right, let's see how price kind of handles once again this month-to-date VWAP. If we can kind of break through and hold it, these are all good signs because that means that maybe the door on that 5,700 level on SPX is opening up. We get unpinned and we start to move. I just want people to be aware that we are in contraction right now, right? So the moves coming out of contraction, right, can be quite big. And one more note before I sign off. What we've been noticing, the big moves have been happening on Mondays, okay? So that doesn't mean it's going to happen this Monday, but we've been seeing some bigger, outsized type of moves on Mondays. That's all I got for you on today's episode, everybody. Once again, just to kind of conclude, right, getting ready for that face ripper rally. Let me just say, it looks like it's gearing up, but if you try to go in too hard, too fast on a certain thing and you're not prepared for a downside move before any face ripper rally, you can get caught off sides and off guards and it can really throw you. So the key here in higher volatility and trying to be ready for a rally that typically comes like very fast and furious to the point where most people miss it, is to just be very tactical, and you typically size down positions, right, and have wider stops, and you could kind of slowly get the feeling for it and build in. I hope that helps. That's kind of what I'm looking at. I'll see you on the next episode.